Now, family members and listeners alike, let's get real cognitive. Let's get real analytical with how to get PAID, trading and investing. Now, I always say, and I will always say, that trading and investing is nothing more than monetizing human behavior and risk management. That's it. Okay? Now, when you scale down and go ahead and get to the inner core of getting PAID from the various markets around the world, you are doing those two things. You're monetizing the behavior of other traders and investors around the world and domestically, and you're minimizing your risk relative to your exposure. Now, at this time, I want to go over a couple of things. A couple of things that if you really pay close attention and you seek to understand and understand what I'm about to tell you, this information will get you PAID over and over and over again. You see, we have to look at humans' perception of losses and expected outcomes. Let me repeat that. We're about to look at human perception of losses and expected outcomes. Now, we're going to look at how human behavior changes once someone owns something and how this impacts their willingness to sell. That is known as the endowment effect. And then I'm going to look at and discuss with you how a person's willingness to take risk is tied to their perception of losses and expected outcomes. And then we're going to look at the importance of keeping track of how you are doing as a decision maker, aka trader or investor. Now, listen to me closely. And like always, this radio broadcast will be placed up on demand on our website immediately following this live broadcast so that you can listen to it again as you need to take copious notes. Now, the endowment effect is the tendency of humans to demand much more to give up an object than they will be willing to pay for that very same object. Let me repeat that. The endowment effect is the tendency of humans to demand much more to give up an object than they would be willing to pay for the very same object. You see, parting with an endowed item would result in feelings of loss to the human. Now, there was an experiment that was done. And one of the experiments used to prove the existence of the endowment effect involved simple coffee mugs. Coffee mugs, like you drink coffee out of. Now, half of the participants in the study were given coffee mugs, and the other half of the participants in the experiment were not. Now, a market was then created for the participants to buy and sell the coffee mugs. Now, actual trades were few in number because those who were given the mugs, aka the sellers, asked twice as much as those who did not receive the mugs, aka the buyers, and what they were willing to pay. You see, what the endowment effect shows us is that human bias towards placing a higher value on what they own over what they don't own truly exists. Merely taking ownership of a stock, a bond, an exchange traded fund, or any other investment asset does not alter its economic value. Remember that. Just because you take ownership of it or control of it, we're talking about a stock, a bond, exchange traded fund, or any other investment asset, does not alter its economic value. The asset is only worth what the prevailing market price is. Yet the endowment effect can cause traders and investors to be adverse to selling the object by making them view the investment as being more valuable than it really is, merely because they already own it. You see, let me give you an example. There was something I saw on the internet recently, and I replicated this impromptu experiment real time at a local convenience store, aka QT gasoline store here in Atlanta metropolitan area. Do you remember a couple of weeks ago there was a big Powerball jackpot, huge Powerball jackpot. It reached like $758 million. Okay, and I saw on the internet where some people who were buying tickets, at the convenience stores around the country, they were interviewed by television reporters, and the television reporters were interviewing the people who had just bought the lottery tickets. Now listen to this. This is very interesting. And the television reporters offered to buy back the lottery tickets that were being bought by the people for double the money. So that meant that people who were buying $2 tickets, the television reporters were offering them $4 for the tickets. But you know what? Nobody would sell their tickets for double the price. You see, I guess it's a case where people weren't considering their expected outcomes. You see, when I saw that on the internet, I went and did the same thing. There are QTs in my general vicinity, so I went to 2 separate QTs. I did the exact same thing with cash in my hand. And so as people were coming out of the convenience store, it was a QT, I would ask them, what price ticket did you buy? And some would say, the dollar ticket. Some would say they bought, the $2 ticket. Or some would say they had bought 5 $1 tickets, etc. And I offered to double them right there with cash in the amount that they had paid. And nobody for an hour and 15 minutes took me up on my offer. Nobody. Think about it now. Think about the odds of winning the Powerball versus the reality of me giving them double their money standing right there in cash. I had cash in my hands now. And nobody for an hour and a half took me up on my offer. You see, the amusing thing is that I think most people who buy those lottery tickets have the numbers picked at random. So it's not like these are their lucky numbers. Now, if I bought a ticket for $2 and somebody offered me $4, okay, then I could do one or two things. Listen to this now. In a situation that is odds driven, I could either take the $4, I would have doubled my money and moved on. And certainly I wouldn't have made, win the Powerball. Or if I still wanted to be in the Powerball game, I would take the $4 and then go back and either buy two $2 tickets or 4 $1 tickets. That would definitely increase my chances of winning. You see, the mind controls the behind. Why didn't anybody in that hour and a half of me standing in front of 2 separate QTs, why didn't anybody say, wait a minute, he's going to give me $4 for this one $2 ticket. Why don't I go ahead and go back inside and get me 2 $2 tickets? Or why don't I go back inside and get me 4 $1 tickets? Nobody thought that way. You see, that's where the uber wealthy get the masses. It's the way they think. It's the way they think. It's the way they think. And nobody doing that impromptu experiment that I performed after I saw it on the internet, the experiment on the internet, nobody took me up on my offer. Now, this would also seem to tie into what is known as loss aversion. And obviously, the whole concept of feeling more pain from a loss than deriving pleasure from a gain. Okay? Now, you see, there's a human willingness to take risk, okay? And it is affected by both whether or not the human views the gains as money wild by, for instance, by happenstance, where they beat the system, or whether or not they have incurred a loss. Let me give you an example. Let's say a gambling casino in Vegas. All right? Now, what if you were in that casino? I've got 3 scenarios I want to present to you. Think along with me now. And it's going to tell me, or tell you it should, what type of person you really are. Scenario number 1. Say you just won $30 at the casino. Now you have to choose between 2 things. All right? A a 50% chance to gain $9 and a 50% chance to lose $9. Or no further gain or loss. You walk away from the table. And that's scenario number one. Okay, hypothetically, you won $30. Now you got to make a decision. Do you take and roll the dice again for a 50% chance to win $9? Or a 50% chance to lose $9? Or do you say, you know what? I'm ahead of the game, I won $30 and I walk away. Scenario number two. Say you just lost $30 this time. The first scenario you won. This time you just lost $30. Now you got to choose between a 50% chance to gain $9 and a 50% chance to lose $9. Or, once again, you've lost $30 and you say, you know what, that's enough. You walk away from the table. That's scenario number two now. Scenario number three, once again, you've also lost $30, but now you have to choose between, listen to this now, a 33% chance to gain $30 more and a 67% chance to gain nothing. Okay? Or you receive a guaranteed $10. Okay, let me go over that again now. Scenario number three. You just lost $30. But now you got to choose between a 30% chance to gain $30 and a 67% chance to gain nothing at all. Or a guaranteed $10. You see, for problem number one, 70% of the people would choose option A, pursuant to problem number one. That is the 50% chance to win or lose $9. You see, participants are likely to take the gamble after being told they just won a sum of money, even though they would otherwise be adverse to risk gains. In scenario number two, where the person just lost $30 and now must choose between a 50% gain of $9 and a 50% chance to lose $9 or no further gains at all, under that particular scenario, 60% of the participants chose option number B, which was what? Not risking any further gains or losses. They saw no reason to risk incurring an additional loss. Notice that, an additional loss, since even if they won back $9, they would still end up with an overall loss. And then, under scenario number three, perceptions change. Now remember, scenario number three was you or the person just lost $30, and now you must choose between a 33% chance to gain $30 and a 67% chance to gain nothing, or being guaranteed a sure $10. See, listen, under that scenario, perceptions change. The majority of people chose option A because this option gave them the opportunity to gain back what they lost, okay, which was a 33% chance to gain $30. You see, what may not be apparent upon first glance is that for each scenario I submitted to you, the two options, A and B, had the same expected outcome. Consider problem three, or situation number three, for instance. There's a 33% chance of gaining $30 and a 67% chance of not gaining anything at all. The expected outcome for option A is approximately $10, the same as option B. This is due to the weighted probabilities of the outcomes. Okay, 0.33 times $30 plus 0.67 times $0 equal what? $10. So, at the end of the day, family members, an intelligent trader or investor will calculate the math for each of these situations that I presented to you and then choose the certain outcome given in option B for each of the scenarios I submitted. You see, most traders and investors, however, often fail to calculate the odds and would make choices largely based on their behavioral bias. You know, one of the best things is to keep track of how you are doing as a decision maker, how you are monetizing human behavior. Now, for most traders and investors, their biggest problem is overconfidence. They read something on the internet and they think it's private information, or they hear some financial guru on TV talking about some stock, and they forget there are millions of other people listening to that very same information. If the information did have value, would it still have value by the time you act upon it? So, my recommendation to you is to keep track of all the investment decisions you make and the manner in which you make them. Okay? And if you have difficulty doing that, then go ahead and invest in some software that will allow you to see how your performance compares to some reasonable benchmark, because this is really hard to do by yourself. And once you start doing that, it will aid you, because we have bad memories, especially about our mistakes. They tend to linger with us, and then we seek to avoid those same mistakes, and oftentimes it digs people into deeper and deeper vortexes to the downside, because they don't analyze how they made the mistake. They remember the mistake, but they don't analyze how they made it. Thus, they're destined to repeat it. Be the intelligent investor, beloved. Think before you act, and always be in front of the market. Know that you must dictate to the market. Do not let the market dictate to you. And you are monetizing the buying and or selling behavior of other traders and investors around the world. And you have to think like that. Not sometimes, but all of the times. When you step on this battlefield called trading and investing, okay? When you step out here, understand and understand that this is serious business. And if you make a mistake, someone else will monetize it, aka capitalize it, aka get PAID from it. Okay? And it's not about luck. No, it's all about skill and making Wall Street pay you right here on